We've operated under price controls. I mean, we've had 52% federal taxes applied to our earnings for many years. Even, I mean, they were higher at other times, but we've had regulations come along, and in the end, business in this country has done extraordinarily well for a couple of hundred years, and it is adapted to the society, and the society is adapted to business. This is a remarkably attractive place in which to conduct a business. Imagine in a world of practically zero interest rates, American business earning terrific returns on tangible equity. I mean, those are the assets that were actually employed in the business. The numbers are staggering. And, people who've had their money in savings accounts or something that get destroyed. But owners of business, if you look at returns on tangible equity, just check them out sometime. And they have not suffered, even as people who own fixed income instruments have suffered enormously. And farm prices are down now. Farmer income has fallen off a lot in the last couple of years, but businesses managed to take care of itself, and for a good reason, because it contributes to and has been the engine of a market economy that's delivered output that is staggering by the imagination of anyone that might have existed 100 years ago. In my lifetime, the GDP per capita in real terms of the United States has gone up 6 for 1. Can you imagine in a society where in one person's lifetime, overall, people have 6 times the real output that they had at the beginning? The system works very well in terms of aggregate output. In terms of distribution of that output, sometimes it can fall very short, in my view. But it'll keep working. You don't have to worry about that. 20 years from now, there'll be far more output per capita in the United States in real terms than there is now. In 50 years, it'll be far more. And the quality will get better. And no presidential candidate or president is going to end that. They can shape it in ways that are good or bad, but they can't end it. Now, Charlie, give something pessimistic here to balance me out.
I want to say something optimistic, and I think that the GDP figures greatly understate the real advantage that our system has given our citizens. It underweighs a lot of huge achievements because they don't translate right into money in a certain way that the economists can easily handle. But the real achievements are, over the last century, say, are way higher than are indicated by the GDP figures, and the GDP figures are good. I don't think the future is necessarily going to be quite as good as the past, but it doesn't have to be.
There's no one you'll run into, at least in my experience, that says, with my same talents, I wish I'd lived 50 years ago instead, and born 50 years earlier. But a majority of the American public thinks that it's a bad time to be born today compared to when they were born. They think your children will not. They're wrong. I mean, it's the pace of innovation. Just think how different you're living compared to 20 years ago in terms of what you do with your time. Now, a lot of people may condemn it or something of the sort, but you're making free choices that were not available to you 20 years ago, and you're making them in a different direction than, I'm still staying with the landline, but you people are way ahead of me.
If you had a silver bullet, which competitor would you take out and why? And sorry, you can't say Donald Trump.
Which competitor and which businesses? I mean, you're asking about which
competitor would you kill if you could? I don't think we have to answer this one.
Charlie's a lawyer. but I've thought about the question. Now, we have lots of tough competitors, and in many areas we're a pretty tough competitor ourselves. And what we want our managers to be doing, is thinking every day about how to achieve a stronger competitive position. We call it widening the moat, but we want to turn out better products. We want to keep our costs down to a minimum. We want to be thinking about what our customer is likely to be wanting from us, a month, a year, 10 years from now. And generally, if you take care of your customer, the customer takes care of you. But there are cases where there is some force coming along that really is, you may not have the answer for. And then, you get out of that business. We had that department store in Baltimore in 1966. And if we'd kept it, we would have gone out of business. So recognizing reality is also important. I mean, you do not want to try and fix something that's unfixable.
And we're not targeting competitors for destruction. We're just trying to do the best we can everywhere.
Spoken like an antitrust lawyer. Okay. We really hope to be the ones that the other guys want to use the silver bullet on it. In a sense, I'm the father of Sequoia Fund in that when I was closing up my partnership at the end of 1969, I was giving back a lot of money to partners, and these people had trusted me, and they wanted to know what they should do with their money. And we helped out those who wanted to put it in municipal bonds for a few months. Bill Scott and I stayed around and helped those people come up with those, but most of them were equity-oriented type investors. And we said there were two people that we admired enormously in the investment business, not simply because they were terrific investors, but they were terrific people. And they would be the kind of people that you'd make trustee of your will. So those two, one of whom is in the room, Sandy Gottesman, our director, and one was Sandy and one was Bill Ruane. They were friends themselves. So Sandy took on a number of our clients, a number of our partners, and they became clients and very happy clients of his, and I'll bet some of them are still clients, or their children or grandchildren are to this day. Others went with Bill. So a lot of them went with both of them, actually. In fact, I wouldn't be surprised if the majority who had a lot of money gave some to Sandy and gave some to Bill. But Bill, we had a lot of people whose total funds were really not of a size that made them economic individual clients. And so Bill, who would not have otherwise set up a fund, Bill said, I'll set up a fund, and it actually had an office in Omaha. John Harding, who used to work for me, became the employee here, and a number of our ex-partners, my ex-partners, joined Sequoia Fund as a way to find an outstanding investment manager, like I say, both for ability and for integrity, and could deploy small sums with him. And Bill ran Sequoia until I think roughly 2005 when he died, and did a fantastic job. And even now, if you take the record from inception to now, with the troubles they've had recently, I don't know of a mutual fund in the United States that has a better record. There probably is one, maybe, or two, but it's far better than the S&P, and you won't find many records that go for 30 or 40 years that are better than the S&P. So Bill did a great job for people. And Bill died in 2005, and the record continued to be good until a year or so ago. And at that time, the management company, or the manager, I should say, took an unusually large position in Valiant, and despite the objection of some people on the board, not only maintained that position, but actually increased it after a fair amount of doubt had been expressed by the board about the advisability of doing that. The record, like I say, to date, still from when started, is significantly better than average. My understanding is that the manager who made the decision on Valiant is no longer running the operation, and that other people at Ruane Cunniff are doing so, and I have every reason to believe that I know that they're very smart, decent people who are good, are probably way better than average analysts in terms of Wall Street. So I think it was a very unfortunate period when the manager got overly entranced with a business model, which I watched the Senate hearings a couple of days ago when Senator Collins and Senator McCaslin interrogated three people from Valiant, and it was not a pretty picture. In my view, the business model of Valiant was enormously flawed. It had been touted to us. We had several people who urged us strongly to buy Valiant, wanted us to meet Pearson, all that sort of thing. But it illustrated a principle that Pete Keywood, I think, said many, many years ago. He said, if you're looking for a manager, find somebody that's intelligent, energetic, and has integrity. And he said, if they don't have the last, be sure they don't have the first two. If you've got somebody who lacks integrity, you want them to be dumb and lazy, you know. And if you get an intelligent, energetic guy or woman who is pursuing a course of action which, if put on the front page, would make you very unhappy, you can get in a lot of trouble. It may take a while. But Charlie and I have seen, and we're not remotely perfect at this, I don't mean that, but we've seen patterns. Pattern recognition gets very important in evaluating humans and businesses. And the pattern recognition isn't 100%, and none of the patterns exactly repeat themselves, but there are certain things in business and securities markets that we have seen over and over and that frequently come to a bad end, but frequently look extremely good in the short run. One which I talked about last year, I'm not referring to Valiant in this regard, was the chain letter scheme, the disguised chain letter. You're going to see chain letters the rest of your life. Nobody calls them chain letters because that has a connotation that will scare you off, but they're disguised chain letters, and many of the schemes in Wall Street that are designed to fool people have that particular aspect to it. And there were patterns at Valiant that I think, certainly if you'll go and watch those Senate hearings, I think you'll decide that there were patterns there that really should have been picked up on, and it's been very painful to the people of Sequoia. And I personally think that the people that are running Sequoia now are able people, and I'll get into in a second the difficulty of managing money. But first I'll give Charlie a chance to comment on this.
Well, I totally agree with you that Sequoia, as reconstituted, is a reputable investment fund, and that the manager, as reconstituted, is a reputable investment advisor. And I've got quite a few friends and clients that use Ruane Cunniff, and I've advised them to stay with the place as reconstituted. And I believe you've done the same thing, haven't you?
Right.
So we think the whole thing is fixed. Now, Valiant, of course, was a sewer, and those who created it deserve all the opprobrium that they got.